Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Intercontinental Exchange, Inc. Annual Report. Intercontinental Exchange, Inc. offers a wide range of businesses and services to various entities worldwide. At its core, the company provides technology and data solutions to financial institutions, corporations, and government agencies across multiple regions. The exchanges segment operates regulated marketplaces for trading and clearing derivatives contracts, commodities, interest rates, foreign exchange, equities, and other securities. This includes data and connectivity services related to exchanges and clearinghouses. The fixed income and data services segment offers fixed income pricing, reference data, indices, analytics, and execution services, as well as global CDS clearing and multi-asset class data delivery technology. In addition to these services, the company's mortgage technology segment provides a comprehensive digital platform for addressing inefficiencies and mitigating risks in the U.S. residential mortgage market lifecycle. This includes application through closing, servicing, and secondary market solutions. Overall, Intercontinental Exchange, Inc.'s businesses and services encompass exchanges, fixed income and data services, and mortgage technology, catering to various financial needs of its clients worldwide. The Intercontinental Exchange, ICE, is a leading global financial market operator. Despite its prominent position, ICE's stock price has remained relatively stagnant over the past year. Several factors may be contributing to this lack of significant change. One possible reason for the stability in ICE's stock price is the company's consistent performance and steady revenue growth. As a major player in the derivatives and commodities markets, ICE continues to generate strong earnings, which can provide a sense of security for investors. This stability can lead to a lack of excitement or volatility in the stock's price. Another factor that may be contributing to the stability is the overall market conditions. The past year has seen a relatively calm period in terms of global economic and financial trends. With no major disruptions or significant events, investor sentiment has remained steady, leading to a stable stock price for ICE. Additionally, the company's diversified business model and expansion into new areas may also be contributing to its stability. ICE has been actively expanding its offerings in various markets, including derivatives, commodities, and foreign exchange. This diversification can help reduce dependence on any one particular market or sector, making the company less susceptible to significant price fluctuations. In conclusion, while there are no specific events or news that have caused a significant change in ICE's stock price over the past year, it is likely due to a combination of factors including consistent performance, stable revenue growth, calm market conditions, and diversified business model. Intercontinental Exchange, Inc. maintains a market capitalization of $96 billion, broadly in line with the industry peer group. Intercontinental Exchange, Inc. trades at a higher price-to-earnings ratio of 29 times and a lower price-to-book ratio of 3.32 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. As this company belongs to the financial data and stock exchanges industry, the liability ratio is less meaningful for valuation. Investors should instead focus on return on assets, ROA, and return on equity, ROE, to better assess the company intrinsic value. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of key segments within a company. In terms of revenue growth, 3 segments have shown significant increases: exchanges, fixed income and data services, and mortgage technology. The exchanges segment has seen a substantial rise in revenue, with the energy futures and options segment experiencing a 100% increase. Additionally, the introduction of new segments such as origination technology and servicing software has contributed to growth. In contrast, two segments have shown significant declines. Agricultural and metals futures and options, which saw an 89% decrease, and financial futures and options, which experienced an 81% drop. However, it is worth noting that the drivers of these declines are not explicitly stated in the provided information. Overall, the growth of revenue can be attributed to a combination of existing segments experiencing increased demand and new segments being introduced, while declining segments may require further analysis to identify underlying causes. Net income and profit margins. A changing landscape, the net income of a company underwent significant fluctuations between 2023 and 2025. In 2024, it decreased by 21% compared to the previous year, but then increased by 17.6% in 2025. This change can be attributed to various factors. On one hand, an actuarial gain/loss contributed to a decrease in net income in 2023 and 2024. However, revenue growth and decreased operating expenses led to an increase in net income in 2025. Profit margins also experienced changes during this period. The exchanges segment saw its profit margin decrease from 15% in 2024 to 8% in 2025. In contrast, the operating margin increased from 36.7% in 2024 to 39.1% in 2025. This increase in operating margin can be attributed to revenue growth and decreased operating expenses. The company's financial performance is also reflected in its funded status. Although the funded status increased slightly from -$116 million in 2024 to -$115 million in 2025, it still indicates a deficit. Overall, the net income and profit margins of this company have undergone significant changes between 2023 and 2025, influenced by various factors such as actuarial gains/losses, revenue growth, and operating expenses. The company's financial performance indicates a significant milestone. According to the provided summary, one of the key takeaways is that the company is successfully generating positive operating cash flow. This achievement is a testament to the company's ability to manage its finances effectively. A review of the supporting documentation on pages 52, 60, 74, 81, and 102 confirms this assertion. The data presented in these sections provides concrete evidence of the company's financial health, highlighting its capacity to generate cash from its core operations. This positive operating cash flow is a crucial indicator of the company's stability and potential for long-term growth. The generation of positive operating cash flow suggests that the company is able to cover its operational expenses, invest in its business, and potentially return value to shareholders through dividends or share buybacks. Overall, this achievement underscores the company's financial resilience and ability to navigate challenges effectively. The company's debt level and interest expenses have undergone significant changes over the past year. A notable reduction in short-term debt from $3,027 million in 2024 to $1,035 million in 2025 is observed on page 94. This decrease is also reflected in the total debt, which decreased from $20,368 million in 2024 to $19,644 million in 2025, page 134. However, there was an increase in net borrowings under the commercial paper program from $1.4 billion in 2024 to $506 million in 2025, page 135. On the other hand, interest expenses have decreased by $107 million from 2024 to 2025, page 95, indicating a reduction in financial costs. The weighted average interest rate on commercial paper notes also decreased from 4.6% in 2024 to 4% in 2025, page 135. Additionally, the operating lease liability increased by $300 million, resulting in a decrease in interest costs related to operating lease liability, page 151. Overall, these changes suggest that the company has made efforts to reduce its debt and associated financial costs, which is a positive trend for the organization's financial health. The financial performance of various segments and regions within the company has been mixed. On a positive note, the exchanges segment saw significant growth, with revenue increasing by 9% in 2025 compared to 2024 and 10% in 2023 compared to 2024. The fixed income data and analytics, data and network technology, and fixed income execution segments also performed well, with revenue growth ranging from 5% to 9%. In contrast, the mortgage technology segment struggled due to reduced consumer and investor demand for mortgages and increased mortgage interest rates. As a result, its revenue decreased by only 2% in 2025 compared to 2024. Geographically, North America was a standout performer, with revenue increasing from $11.2 billion in 2024 to $12.8 billion in 2025. Europe also saw positive performance, although specific details were not provided for other regions. Latin America, on the other hand, experienced a decline in revenue, falling from $1.6 billion in 2024 to $1.8 billion in 2025. The Asia-Pacific region's revenue increased from $3.8 billion in 2024 to $4.2 billion in 2025, but specific information was not provided to determine its performance. Overall, the company's financial performance varied across segments and regions, with some areas experiencing significant growth while others struggled. The company's outlook and strategy are centered around several key areas. Firstly, it is evident that the company is committed to expanding its global presence through strategic growth initiatives. This focus on expansion is complemented by a strong emphasis on subscription-based services, with many contracts ranging from 1-5 years. In addition to its growth initiatives, the company is also prioritizing liquidity management through committed repurchase agreement facilities and committed FX facilities. This suggests that the company is taking proactive steps to ensure it has sufficient liquidity to meet its financial obligations. Furthermore, the company's investment in data and analytics products and services, such as ICE Mortgage Technologies Analyzer, indicates a commitment to innovation and staying ahead of the curve in terms of technology. Overall, the company appears to be well-positioned for future growth and success, with a clear focus on strategic initiatives and liquidity management. The company has made several strategic moves through acquisitions and divestitures to shape its business landscape. In terms of acquisitions, the company has purchased Black Knight in September 2023, expanding its capabilities. Additionally, it acquired ICE Digital Trust, LLC's digital asset custody business, in May 2025, further enhancing its services. The company also made an investment in Dun & Bradstreet Holdings, Inc. On the other hand, the company has divested from certain investments to optimize its portfolio. Notably, it sold its entire stake in Dun & Bradstreet Holdings, Inc. for $187 million, resulting in a total loss of $3 million. This strategic decision reflects the company's commitment to making calculated moves that align with its business objectives. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends, which are payments made to shareholders from the company's profits. According to the provided information, the company has indeed paid dividends on multiple occasions, as mentioned in pages 49, 102, and 141. In addition to paying dividends, the company has also taken steps to return value to its shareholders through share buybacks. This involves purchasing back shares of common stock from existing shareholders, which can help increase the value of each remaining share. The company's history of share buybacks is documented on pages 44, 77, and 140. Concerns about inventory buildup and supply chain disruption are evident in the industry. The EU deforestation regulation may slow down physical trade of cocoa and coffee, rendering existing EU inventories unusable, page 17. This is compounded by supply chain issues, trade disputes, and tariffs, as well as government interventions related to the energy crisis in Europe, page 20. Furthermore, disruptions to global supply chains due to pandemics or public health emergencies pose a significant threat, page 27. Additionally, businesses may struggle with acquiring necessary hardware and products on acceptable terms. The reliance on third-party suppliers also creates risks, including potential losses of services from these suppliers, page 35. These factors collectively highlight the vulnerability of the industry's supply chain to disruptions. That concludes the financial summary for Intercontinental Exchange, Inc. Feel free to comment below, and I will be happy to answer them when possible.